Hello everyone, I'm Siddhant. Today we are taking the chapter number 17, which is the Treasury Risk Management. In this chapter, we will take the risk associated with the Treasury only, and there is a separate module for the risk management. And in this, we will only stick to the risk related to the Treasury. Okay, in the banks there are generally two kinds of the books which is related to the general banking services like loans and the deposits, which is and another book is for the treasury, that is called the treasury book, and there only treasury things are recorded. And in the treasury book there is a lots of risk that is associated. One of the risk is credit or the default risk, another one is the market risk, and the third one is the operational risk. Under the market risk there are three another kinds of risk which are under market risk, that is liquidity risk, currency risk, and the interest rate risk. So starting with the credit and the default risk, this is also known as the counterparty risk. For example, you have given loan to someone, and they will return our loan or not, so that is called a counterparties risk. And in the market risk, the three types of the risk is liquidity risk, currency, and the interest rate risk. In the liquidity risk, what do you mean by that? Liquidity means, for example, you have taken money from the market for a very short duration, and you invested that money for the longer duration, bonds or the loans. So what is the problem? The problem is liquidity will be to pay the amount. So after 1 year you need to pay the amount that you have taken from the market, but the one that you have given for the 10 years, the loan you have given for the 10 years will come only after 10 years. So that is called a liquidity risk. The currency risk is the risk associated with the currency. For example, the fluctuations between the Indian and the dollars. So if the fluctuation is more, there will be a lot of risk associated in the treasury. Next is the interest rate risk. What is that interest rate risk? For example, you have taken a loan from the RBI at the 4% interest, and you gave the loan to the customer at the 6% of floating rate of interest. So what, after 1 year, that floating rate becomes 4% from that 6%. So that will create a problem. So that is called a interest rate risk. Next is the operational risk. Operation means anything related to the process or the people, that is a operational risk. In the Nirav Modi case, there was a operational risk of because of the swift as well as the people involved in it. So that is called the operational risk. Now the risk can be measured through the we can measure the risk through what? Through value at risk method. In the value at risk, we will see that there are statement that is very much important, that how you read that statement. For example, it is written that 5% of value at risk. So what does this mean? This means that 5% of the amount that you invested or you have given loan, only the 5% of it will be at risk, otherwise 95% are safe. So it simply means, this statement means, there is another statement, 5% of value at risk of 2.5 crore loss. So what does it mean? This statement means that 95% chances that your loss will be less than 2.5 crore, and 5% chances that your loss will be greater than 2.5 crore. And there is another interpretation that out of 100 times you have invested in the same business, 95% times you will not be in loss, that is your loss will be less than 2.5 crore. Only the 5 times your loss will be greater than 2.5 crore. So this is the interpretation that you need to understand. Now we will see the next concept, that is the duration. So what do you mean by duration? It's the duration measures nothing but an impact of the interest rate on the price. So as we know that the relationship between the bonds bond yield is equal to the coupon amount, okay, divided by market price. So there is a relation exists between the yield and the market price. So the inverse relationship exists. Now the duration talks about the impact of the interest rate on the price. That's it. That is about the duration. It is important in the study of the impact of the interest rate on the price. So if the interest rate lowers, the market price will increase because it has a inverse relationship. Now the duration concept is given by the Frederick Macaulay, and longer duration of any bonds means the greater is the sensitivity. For example, the you have taken a bond of 10 years and another you have taken for 5 years. So in the bond of 10 years there is a more chances that you will face the sensitivity, you will face the losses, because might be after 5-7 years that recession happens and you might lose more. So the more the time, the more is the sensitivity. Next is the next risk management. As far as this chapter is concerned, this chapter talks about only one thing about the risk management is through the derivatives. So what are derivatives? In the last chapter we have learned what is futures, what is swaps, what are options, etc. So that are nothing but a kind of derivatives. In the derivatives, what we were doing in the last chapter, that we are protecting that, for example, $1 cost 75 today, and after 3 months the $1 might become 80. So in today's only we did the agreement and signing an agreement saying that I will pay the amount as per $1.75 today. This is an agreement that is called a future agreement, and that is a part of derivatives. So that's it with the concept. Now another terms which is important as far as this is concerned is leverage. What do you mean by leverage? Leverage means to build up assets with the given capital. For example, you have 100 rupees. So how you can make that 200? That is a leverage. How you utilize that 100 rupees so that you can gain a maximum capital from that 100 rupees. So that is called a leverage. In any company, the leverage can be measured by a ratio called debt by equity, and in the banking we measure leverage through the CRAR, that is capital risk adequacy ratio. The another concept is the modified duration. Whenever you find a duration, there is a formula for duration. You don't need to study, but there is a formula to find duration. When you find the duration, when you divide the duration with the interest rate, that is called a modified duration. Next concept is the volatility and the sensitivity. Volatility means the degree of the fluctuation of the markets with reference to the variables such as interest rates and the exchange rates measured as a standard deviation from the mean of the variable is called volatility. In simple words, there is a concept we have learned in the class 12, that is the variance variable and finding a standard deviation. So this volatility is to find the fluctuations in terms through the standard deviation and the variance concept. So that is the volatility. And what do you mean by sensitivity? Sensitivity means if one of the factor which influences something changes, the main thing will change. For example, the market of the price of the vegetables, the price of the fruits depends on the diesel cost. So diesel is a kind of sensitivity to the vegetable cost and the fruits cost. So that is the concept of the sensitivity. Now in this chapter, one very important thing is the exposure limit, learning of the exposure limit. For example, before the starting of the year, the banks determines that how much loan they are going to give, how much in the treasury department they are going to invest, and how much in which company they are going to invest. For example, in this year, the government, the treasury department might think that it will be very beneficial if they invest in the health department, because nowadays only the health department is booming. So investment in the treasury will be decided every year and they are reviewed every year, and in which, even in the health department, which company they are going to invest, they decide in the starting of the year. So that is called a counterparties. And in order to invest in the counterparties or any company, they see some parameters before investment. So what are those parameters? That is the net worth of the company, track record of the company, and the market reputations of the company. And this exposure limit are decided by the bankers itself, but there are some ceilings applied by the Reserve Bank of India, that the maximum amount of the business that you can invest in any company is 5%. So that's these things you need to remember. Now then we see, now we will take the questions. Question 1. Banks fix exposure limits under treasury functions for which of the following counterparties? So banks deal, so which are the counterparties that banks deals in? The banks deals with the banks through what? Through certificate of deposits. So the banks deals with the banks with the certificate of deposit, call money, notice money, and mutual fund through any of the products, treasury products, and through the security brokers through the securities itself. So the option D is the right answer. Next question. Value at risk loss incurred due to volatility of. So the value at risk, so value at risk, we find value at risk only when there, whenever there is a risk with anything. So in whatsoever, in whatever things there is a risk, we will find the var of that. So in interest rate, there is an interest rate risk, so var can be found here. Exchange rates, yes, in the currency forex there is a risk, currency risk, so exchange rates also we find the var. And the commodity prices, even in the commodity dealings there is a risk associated like the market risk, so there is a var can be find. So the option is D, all. Next question. Value at risk at 99% means loss will be 1%. This is a general statement you need to understand. Whenever it is saying value at 99% means loss will be 1%. Which are approaches of value at risk? So which are the approaches of the value at risk? The value of risk can be found through various methods. So this parametric approach is one of the method, Monte Carlo approach is another method, and historical approach is another method. We don't need to enter much into this, we just need to remember this name. That's why I kept this as a question. And what, so the option is A, B and C, not D. Altman Z approach is only used to find the bankruptcy, whether this company will undergo a bankruptcy in future, that is determined by the Altman Z score. Next question. Effective return on the bonds depends upon. For example, you buy a bond, let's say the bond issued by the primary in the primary market at 1000 rupees, and after 5 years you will get 1100 rupees. Okay, now this is taken by your friend. Now your friend doesn't want to have this bond, now he will sell it to you in 2 years in the stock market to you, and you buy it at 900 rupees. So still you have 3 years to keep the bonds, and you will get coupon amount every year after the second year. So it is asking that what effective rate on return on bonds. Return on bonds means whatever you are gaining out of the bond, that is return on the bonds, depends upon. So it depends on the coupon rate. Yes, it will depends on the coupon rate. For example, if the coupon rate is 100%, you will get more amount. If it is 10%, you will get less amount. So it depends on the coupon rate, whatever you are gaining every year. Market price, yes, it will depends on the market price. Let's say you have bought the bond for only 100, then you will gain more, because after 3 years you will earn 1100, that is fixed. And what if you at market price, let's say 500, you will earn less as compared to the 100, and now you are taking bought this bond at 900, so you are gaining less as compared to 100 or 500. So it depends on the market price also. Option C is maturity. Yes, it will depends on the maturity. For example, you bought this bond 900 and there are 3 years still to go before it matures, so your net return percentage will be less, because it has 3 years of time. If you find the present value of 900, then it will be very less. And what if you have bought just 1 year before it matures, so you will earn more on that. So it also depends on the maturity. So option is D. Relationship between bond price and the yield, we have seen in the formula, it is indirectly proportional. Next, when one account, funding account, is debited, another account, security account, is credited at the same time in case of the security purchase is called. For any purchase you do, like the securities or any equities, even if you buy from the share market, what it does, it will deduct the amount from the from your account, then it will at the same time it will give you the securities in your securities account. There is a separate security account that is maintained by the NSTL and CDSL, that is a security accounts. So you can keep your securities at that account. So in this question, when one account funding account is debited, another account security account is credited at the same time, in case of security purchase is called, there is a term for this which you need to mug up, that is delivery versus payment. It is very common term in the market, in the treasury. So that is the delivery versus payment. Why? The name is that in one hand you are giving money and in another hand we are giving you delivery of the securities. So that is the delivery versus payment, not the payment versus delivery. So the option C is the right answer. Interest cost of funds in trading position is called, it is called carry. It is a facts you need to remember. Interest cost of funds logged in trading position is called carry. Next question, items like interest swaps that do not appear in the balance sheet are called, okay, there are something called a contingent liabilities which we do not mention in the balance sheets. So but we have invested some amount in that, and in future that might be an asset or might be a liabilities. It depends on the future, so we can't say, we cannot designate either in assets or liabilities just now in the balance sheet. So that is called a contingent liabilities, and that is also called a off balance sheet items. It is mentioned separately in the note section, that is called a off balance sheet items. If you want to take an example, for example, you have invested in any let's say bonds. In future, what you are going to, what is the market price of the bonds, you don't know. So that is termed as a contingent liabilities. If the bond is like that, it is depends on the market, then so it's all balance sheet items. The line, next question, the line where the yields of risk free securities for different maturities at a given point of time are graphically plotted is called, it is called yield curve. It's a factual you need to remember. Next question, valuation of the trading position applying current market value as at end of the day is called, it is called mark to market. It is another term used in the treasury market, where you have to understand that valuation of the trading positions applying current market value as at the end of the day is called the mark to market. So it's just a valuation of the price of the thing. The next question, the dash, the duration. The dash is the sensitivity of the bond price to changes in the interest rate. We have discussed in the concept as well that the longer the duration, the greater is the sensitivity of the bond price. The shorter the duration, there will be less sensitive to the price. So we will take the next question, that is bonds. Bonds trading at the stock market can be traded as, okay, for example, you have taken a bond from the primary market, and after some time you don't, and that bond is for 5 years maturity, but after 1 year you need money, you need liquidity, so you sell this bond at the stock market. Now in the stock market, whenever you issue these bonds, either these bonds can be issued at discount. For example, you bought at 1000 and after 5 years you will get 1100, but no one is asking for this bond, so you issue it for 900 of rupees only, and now they will take this bond because you issued it at a discount. And for example, another example, that you want to issue the bonds, you want to sell the bonds at 1100 of rupees in the market, so that the bonds are issued at the stock market at premium, because you bought at 1000 and you sold and the stock market at 1100, and can be traded at coupon rate 100%. Yes, for example, at the starting you bought 1000 bond and the coupon rate can be anything, so it can be also be possible that it can be 100% also, so the coupon rate 100% is also possible, so the option D is the right answer. Next question, derivatives are market products widely used by bank treasuries chiefly. Okay, as we discussed, the derivatives is nothing but to protect ourselves from the future fluctuations, volatility or the sensitivity. So derivative products can be swap, futures, forward and hedging, etc. So the derivatives are market products widely used For to manage risk, yes, derivatives, it's all about to manage risk, including the ALM risk. Option B, to cater to the requirements of the corporate customer. Yes, derivatives fulfill the requirements of the corporate customers, because they need to do an agreement. They need to be in agreement in order to save themselves for the future risk. Option C, to take trading positions in the derivative products. Yes, in derivative products, the trading position can be open position, closed position, that we have discussed in the last chapter as well. So the option C is also there, and option D all. So the option D is correct. The derivative product can be directly negotiated and obtained from. It can be, so where from where you can find the derivative products? You can find it from the banks. Yes, you can also deal the derivative product with the investment institutions, and you can also deal the derivative product in the stock exchanges. So the option is D. That's it. Thank you. Please like and subscribe. Thank you.